Morning, everybody. Thanks for being here. And I guess we're now at the middle of the year, and if you've invested in the US, if you've invested in Magnificent Seven, if you've actually even held cash, MAST bills, you're all very happy, no doubt about it. But I think it's time to think about the second half of the year, what looks interesting out there that maybe has been overlooked, something to think about, something we believe in, and that's obviously Asia. So that's my topic for the day, and I'm trying to encourage us to think about Asia and the prospects that are out there, as opposed to just thinking about what's already happened. So why Asia? Why now? I'll give you a couple stories of why I think so. First thing always is to think about the economy. And the US is recovering, the rest of the world is recovering. And if you look at this chart, on the left-hand side is the world GDP, 23, 24, and 25. On the right-hand side, in the red boxed up area, it just shows you that actually the Asian economies are leading. And we have been leading the way for a long time, and even going forward into next year, despite everything that you hear about China, and that's in the right box here, China is still growing about 5% a year. So that's another bone of contention. I know China is always a very easy thing to poke your finger at, but I think there are also things that are happening there which are positive for us to think about. So first things first, the economy is still very solid in Asia. It's still growing faster than the rest of the world. That's point one. Now, China, yes. When you think about China right now, everyone sort of shakes their head and say there were all these, common prosperity ideas, and not great. The property market is terrible, etc., etc. Don't blame you for being skeptical, but there's also a time to think about when it gets so cheap that it really is time to think about it. So let me tell you about what's been going on in China. Yes, it's not been good, and the government acknowledges that, but that's also when they wake up and say it's time to make things better. The people put trust in me, the 1.4 billion people. I need to do something about it. I put them through a hard time. I've locked them up post-COVID, and finally I've reopened, but I need to get things going. I just can't wait for something to happen. So the two most important things in China, one is doing really well, one is not doing so well. The one that's not doing so well is property, no doubt about it. But it's come down to such a level that the government needs to do something about it. And what happened a couple months ago was they put together this massive package, 55 billion Singapore dollars, and said, let me take out all the property in the market as much as I can, the unsold units, the uncompleted units, make them social housing, low-cost housing. That's how I can clear some of the stock. It won't clear all the stock, but it takes a big chunk out. That's the first point. And it also sends the message to the market, confidence to the market, that the government is prepared to do something. I agree it's not enough, but it's a great first step. So that's what has been happening. But what's also important is to say that while we wait for property to stabilize in China, global manufacturing has been improving, no doubt about it. You can talk about AI and NVIDIA till the cows come home, and great structural story long term. But this chart here, let's see. On the left-hand side is the PMI, Purchasing Managers Index. Just shows you a recovery. Green is emerging markets, this one. It's recovering faster than developed markets. Okay, and on the right-hand side, it's just this is a leading indicator, the green line pointing upwards. This, therefore, will have to point upwards as well, and that's Chinese exports. So two parts to the Chinese economy, external and internal. Internal is stabilizing, external is definitely improving, just like for all of us in Asia. Just one point which is very, very interesting, I think everyone should know. When everyone talks about NVIDIA, do you know how much they actually spend in Asia to make those wonderful AI chips for the rest of the world? Of their spending, 70% of cost of goods sold is in Asia, 70%. Of that 70%, 35 is in one company alone, TSMC. Everyone knows, everyone loves that. Of the other 35%, 15% is in Taiwan, and 20% is the rest of Asia. That's from NVIDIA alone, one company. So that's how much Asia benefits. It's like the effect cascades down from this wonderful company to everybody else. And no one else has thought about all those other companies below, 70% of which is Asia. So that's on the manufacturing side. Interestingly also, we know, and we can debate this endlessly, when are interest rates coming down in the US? Well, some people say 2 this year, 1 this year. We agree. Some people say 4 next year, 4 cuts meaning. We disagree. We think it's only 1 next year. The reason is because if there are 4 cuts next year, that means there's a recession coming. Nonetheless, it doesn't matter. Rate cuts are coming. They are coming, no doubt about it. Could be September, could be December, depends on elections, many things, but it has to happen. Now, this is a very interesting relationship between the strength of the dollar and Asian market performance, Asian equity market performance. So green line is the Asian equity index, red line is the dollar index. But what does this have to do with interest rates? When interest rates come down, the dollar weakens. That's essentially how the relationship works. So red line goes down. I'll make it very simple. Red line goes down, green line goes up. That's it. Dollar strength, red line goes down, green line, equity strength, Asian equity strength goes up. How it works is that when people move away from the US dollar because of interest rates coming down, that means that liquidity, those flows will come into Asian financial assets. And that's that relationship. And it's worked since, well, this is from the 80s, but this is a standard formula which everyone understands. So dollar has been very strong because of rate hikes, because of the strength of the US economy. We don't think it's going into a recession, but as long as it stabilizes, some rate cuts come slowly, that's enough for dollar to stabilize, weaken slightly, and good for Asian financial assets. Not just equities, but fixed income. We can talk a lot about how Asian equities are cheap, but cheap can stay cheap. Doesn't mean much. But again, that relationship which I just told you about, there's another way to look at it. This one is Asian tech against US credit, meaning US corporate bonds. It's the same relationship. I mean, without going into all the details, it points to the same thing, which is dollar weakness means that Asian tech will outperform US credit. It's the same idea, just expressed a different way. And finally, not finally, but on the market, you can also see in this chart that Asian earnings are actually catching up and starting to do better than developed market earnings. So that's the gray line, which is the difference between Asian earnings and equi earnings, or meaning all country world index earnings. So look at the gray line on the left-hand side. That is picking up again after coming down, or heading down, but still positive. It just shows you that the trend of earnings is coming through, is filtering to Asia, and Asian earnings are picking up. And the chart on the right is the valuation from the Asia Pacific ex-Japan PE, meaning price to earnings ratio, compared to the world index. It's come down, or rather the other way around. Asian Asian valuations have not gone up that much, but developed market valuations have gone up a lot because they've done so well. And that's why you're happy and great. But it's time to also think about cheap. Okay. Same story for China earnings. A lot of the bad news is in the price. We've talked about China for not just today, but for the last 6 months, 1 year, 2 years already. Everyone knows Country Garden's gone bankrupt, Evergrande, etc., etc. All that's in the price. Everyone knows about common prosperity. Everyone knows about post-COVID lockup, reopening, disappointment. It's very easy to shake your heads and say, well, yeah, they're going to do it again, disappoint us. But earnings has started to stabilize, And again, if nothing happens on the Chinese property side, at least if it doesn't worsen, that's good enough. Because the other part of the Chinese economy is manufacturing, and that part is definitely picking up. So that's the point I'm trying to make. It'd be great if both move up at the same time, but if it's only one, for now, it's pretty good already as long as the other one doesn't go down some more, okay? And while we talk about valuations and Asian equities and all that, let's not forget about bonds. I mean, I think we all own bonds, we all own MAST bills, but as we all know also, those MAST bills, 6 months rates are coming down as well. It reached 407, it's now 370 thereabouts, you know? We all watch that very closely too. But still, it's important to point out one simple fact, which is that the yields, the dividends which we get in Asia are still better than the rest of the world. So, you know, reinvest in Asian equities, very happy with that, but also Asian bonds are giving you a good return as well, just from the yields and the coupons. I come from Schroders multi-asset, so I look at both equities and bonds and all other things like commodities, alternatives, etc. But for me, combining in a certain way the asset allocation within equities and fixed income is very, very important. We may switch between one and the other at different times tactically, but we like both is the point. And this outlook is also improving in Asian credit. Now, if you look on the right-hand side, this shows you the component of high yield within the regional Asian credit index. High yield means just poor quality bonds, to put it nicely, not so nicely, poor quality bonds. And the reason why the quality is better, from the left to the right on the right-hand side chart, it's gone from an average rating of BBB plus to A minus. So that's an improvement, BBB plus to A minus, simply because a lot of all those Chinese real estate bonds just dropped out because they all went bankrupt. So the quality has improved. The yield is also still very strong. It's now about 5.5%. That's the left-hand side chart compared to the average for the last 20 years of about 4.5%. So still a good thing to own. And that's why we like both Asian credits, meaning Asian bonds, as well as Asian equities. And this again is the same relationship between the dollar weakness and the value or the rebound in Asian assets, in this case, Asian credits. It's the same idea, not just equities. Okay, so I've given you the broad outlook. Quick summary. Economy is doing better in Asia compared to the rest of the world. China stabilizing, manufacturing getting better, property stop crashing, valuation cheap, earnings recovery ongoing, global manufacturing great for the rest of us in Asia. But you know, there are also specific themes, and these are three which we like in Asia, but there are others, but these are the three that sort of stand out at this point in time. AI, you cannot get away from any investment conference like this without talking about AI, like it or not. So like I said already, so much of what is done for a company like NVIDIA or AI in general, a lot of that is done within Asia. We have a wonderful company in Taiwan called TSMC getting very technical, a little technical, in the high-end type of wafers that they produce, 357 nano, they have 80-90% market share. Nobody can compete with TSMC at the high spec end. Not the American companies, not the Chinese companies, nowhere near 80-90%. It's actually amazing. It's just amazing that a Taiwanese company can conquer the world in those high spec semiconductors. But they do, and they've done very well. And as a result, the ecosystem within TSMC in Taiwan and the rest of Asia is how we benefit in Asia. And that's what is great for this theme. We are Asia are beneficiaries of AI. And what I'm saying here is that while valuations have recovered, that's the left-hand chart, Taiwan tech stocks compared to global tech stocks, is still much cheaper, 20% still, despite everything. You know, I'm sure, that NVIDIA is up like 150% this year. It's staggering. TSMC has gone up, okay, it's a lot, maybe 40, 50%, but it's still a lot cheaper. And then there are others around that in Taiwan which are just as good. Okay, so this is just a little bit more detail about AI and all that. And this is what I was saying earlier. If you look on the left-hand side chart, this is looking at the red circle on the left-hand chart. Those are the high-spec wafers that they produce, semicon chips. This is in the 5 and 7 nano range. That's the market share that they have, 90, 100%. It's crazy. This is not even talking about the 3 nano, which is something else. So there are other companies also which we like within this space. It's on the right-hand side. Hynix is another, and this also gives you a sense of how that has performed and how the other how Taiwan as a whole has performed, etc. Okay. So Japan is another thing that we like within Asia. All of us love Japan as a travel destination. All of us are watching the yen very carefully. Yes, it is about 119 yen to 1 Sing dollar, and all the travel fares right there. You know, we all go there. That's fantastic. Nothing wrong with that. But it's also come down a long way. So we just need to watch that very carefully. But definitely what is happening is that sort of monetary easing through the weakness in the yen is positive for the economy. It's slowly improving. It's very easy to be a naysayer, but it's slowly improving. And that is seen in, for example, that chart on the left, land of the falling poison pill. This just means that corporates, companies in Japan are willing now to be more open to give back to shareholders instead of always taking care of corporate leadership first and foremost. No. And that has been changing over time, and it's a mandate from the government, it's a mandate from the authorities also in the stock market. And that has also resulted in the improving ROE, return on equity, for Japanese corporates. That's the blue line that's been improving very sharply. But not just in Japan. It's very easy to say, hey, congratulations, thank you very much. But other countries around the region are also learning, and they're saying, if these guys can do it, we can do it too. Another very cheap market in the region is actually Korea. And they had the same problems as Japan. These huge conglomerates, which all of us know, Samsung, LG, SK, Lotte, Hanjin, whatever it is, they all had the same problem as well. Meaning they own shares in each other, they pay each other huge salaries, they give businesses to each other without tenders, inflated prices. That has got to stop, and they know that too. And Korea has come up with this plan called the Corporate Value Up Plan. Essentially, it means that what Japan is doing, we're trying to follow. And it's slowly taking shape. Some companies are understanding that what they need to do is not just good for external shareholders, but because it also affects themselves. They own the companies, the families behind them. It's good for them as well. So this is slowly taking place, and we see that so-called value up plan being positive for the Korean market as a whole. So another theme in Asia, aside from everything I told you earlier about AI and growth and GDP and all that, and China as well, they're doing this. Slowly but surely, all these things are happening. They are ranked so poorly on the corporate governance scale. That's on the left-hand side. Japan is now number 2, Korea is 8, China is 10. They don't want to be 8 and 10, they want to be higher. So that's the idea behind that. And finally, in India, the election's just over. They can go back to business now. Modi didn't get as many seats as he wanted, but he's still a very strong man in charge. And it's very clear that the agenda does not change. So the economy continues to chug along nicely. And importantly, India is also a beneficiary of AI. There are a few steps to consider here. AI means chips, means data centers, means lots of power needs. India is really good at producing power, utilities. Power centers are scattered all over the region. India will benefit from that. especially if they're doing more green power, more sustainable energy production. And that's what they're doing as well. So India is not just India growth generally, Modi generally, but also a specific theme like India renewables. So that's what we like. And I'll just end with a final slide. Just a reminder, I'm from the multi-asset world in Schroders. We like what's going on in Asia, specific parts of Asia, specific parts of equities, specific parts of Asian equities, specific part of Asian bonds. What we do also is to allocate between these specific parts to give you that value. Why now? Well, as I already told you, a lot of things that we like, Asia, AI beneficiaries, corporate reforms, Asia renewables. And that idea, remember, of how if we see the rate cuts coming, Asian currencies strengthen, Asian financial assets do well. This actually happened 2 days ago. I don't know if you knew that. Was it yesterday? That was 2 days ago. On Wednesday night, the US released the latest CPI number, which was below expectations. Immediately, the dollar fell. Immediately, the next day, Hang Seng Index was up 2%. So that's how powerful that move can be. Let me tell you that when the first rate cut finally happens, sometime later this year, when it finally happens, that's when everyone will suddenly realize that that relationship is real. But we can see that happening already. So just watch out for that. And why multi-asset? It gives you the opportunity to participate in income and structural growth in Asia and allow us to make those decisions for you if you invest in our funds. But I leave that to you. Think about Asia. I think it's an opportunity. Thank you.